Hi there, it's Isilia here from Tax World. Today, I'd like to talk to you about Section 135 of the Taxes Consolidation Act 1997. Section 135 provides additional rules in relation to distributions. New consideration refers to money that is not part of the company's existing assets. A share premium can be considered as new consideration unless it's already been deemed a repayment of share capital. Profits transferred directly to the capital account are not considered new consideration because they are from the company's assets. Consideration based on the value of a company's shares or voting rights is not new consideration unless it is one of the following: a distribution from profits, a repayment of share capital, the renunciation of rights to share capital when acquired by the company. In a share exchange involving two close companies, the consideration derived from the share capital of the first company for shares in the second company is considered new consideration for the second company only if it exceeds the new consideration received by the first company for the issue of those shares. There are anti-avoidance measures in place. For instance, when companies conspire to pay distributions to each other's shareholders, all involved companies may be treated as if actions by one company were done by any other. Moreover, if consideration for selling shares in a close company comes from the company's assets, the amount received for the sale is considered a distribution and not a gain for the selling shareholder. This is illustrated by an example where NewCo is used in a management buyout to acquire shares in a target trading company, and the finance comes from dividends paid to NewCo from the target. In such cases, the transaction is treated as income distribution to the shareholder who is leaving. Another anti-avoidance measure is for companies that are part of a 90% group. A distribution made concerning shares in one company includes a distribution regarding shares of another group member. However, the distribution doesn't actually have to be made to the other group member. Life insurance companies are an exception if they acquire shares in their quoted parent company as part of their investment portfolio. A distribution is considered to be paid out of assets if the cost is borne by the company. Furthermore, a share includes stock and any other interest of a member in a company. The term issuing share capital as paid up includes paying up of share capital that was previously issued. A security includes a security that does not create or evidence a charge on assets. Interest paid on an unsecured loan is treated as if it was paid in respect of security given for that loan. This means any loan can be seen as a security, and the interest on an unsecured loan can be treated as a distribution. If unquoted securities are issued at a discount or are repayable at a premium, the principal should not be taken as exceeding the issue price unless the terms of the issue are comparable with those for quoted securities. This means the amount by which a subsequent repayment exceeds the issue price might be a distribution. Finally, anything done in respect of a share or security applies to actions by the holder or former holder of the share or security. It also covers actions in obtaining an option on the share or security. I hope you found that useful, and I'll see you in the next video.